Yo, what's up everybody? My name is Ryan. I'm a CPA and today I'm going to be talking about the bonus depreciation and what's changed over the past few years and why it's important. And first of all, I'm going to have to talk about what depreciation is to give you an idea if you're not familiar about it, and kind of go through the changes and how it differs from the Section 179 depreciation, which I'm sure many of you are quite familiar with. It's a very popular thing that's going around social media, so I think it'd be good to talk about that for a little bit as well. So let's start with depreciation and what it is. Depreciation is a business expense. You can't take depreciation expense for personal things, but if you run a business, it's an expense. And what it is it's an expense that you get to take on capital assets. So capital assets are things that you buy for your business that can help you profit and has a useful life of many years. So for those things can be like vehicles, machinery, manufacturing equipment, real estate. Those are capital assets. If you're buying things like pens, paper, little office supplies, those are not capital assets. They're just regular expenses, and so you get to take the expense on the full cost of those immediately. Whereas depreciation, you buy a vehicle. If you buy, like, let's say a vehicle, without bonus depreciation, you have to depreciate that entire cost of the vehicle over 5 years. So you buy it for $20,000. Let's say you use a straight line depreciation method. You take $4,000 deduction each year for 5 years. And that's pretty much how depreciation works and what it is. Bonus depreciation is an IRS incentive to incentivize taxpayers who own businesses to purchase these assets to run their business and make it more profitable. And the incentive is to give you more of an expense up front rather than having to take equal expense or a smaller expense over the useful life of the asset. So in 2017, when the Tax Cuts and Jobs Act passed, the bonus depreciation expense was bumped up from 50% to 100% of the cost of the assets in the first year. That means if you buy a qualifying vehicle, let's say, let's use the same example for $20,000, you can take the full $20,000 deduction in the first year. Now, the issue here, some might see it as an issue, some might not, but once you take that full $20,000 deduction in the first year, you have no other deductions related to that depreciation expense for that vehicle in the following years, because you took the entire cost of expense in that first year. Now, a lot of people see it as a benefit, and I do too, time value of money and all that. So it is a pretty nice incentive. So what's been changing though, since the Tax Cuts and Jobs Act passed, it allowed 100% depreciation from 2018 through 2022. Now, starting in 23, that benefit starts to phase out now, and it ends in 2027. So what does that mean? That means in 2023, instead of 100% bonus depreciation on an asset you buy, you only get 80%. So, you buy a car for $20,000, you can only take 80% of that as a deduction in the first year, and then the other 20% has to be depreciated over the remaining useful life of that asset. And then in 2024, that number goes down to 60%, and then 40%, and then 20% until 2027, where it is zero. There's 0% bonus depreciation. It's completely phased out at that point. Right now, currently, there's some legislation that's trying to be worked through, trying to be passed to extend the 100% bonus depreciation for a little longer, which means bringing back 100% for 2023. And if that passes, then, returns will have to be amended if you already filed and all that. And it will hopefully extend 100% for longer and maybe extends the phase out period to a later time. So that's in the works, but right now the law shows 2023 is the start of the phase out period. So just be aware of that when you're looking at bonus depreciation. Now, there's a lot of rules that go into which assets are qualified assets that are eligible for bonus depreciation. I'm not going to get into too many specifics. You can find that online on the IRS's websites, on many articles. There's limitations to how much revenue your business makes. This is an incentive for smaller businesses. So, if you're a big business, your revenue is over $10 million, let's say, you may not qualify for this incentive. But this is a small business incentive, so there's going to be limitations on revenue. and there's going to be limitations on how much assets you buy in a year that qualify for bonus depreciation. Other assets that qualify, they have to have a useful life of 15 years or less. So generally, real estate property are not eligible for bonus depreciation. Those get depreciated over 27 and a half years if it's a residential, or 39 years if it's a commercial property. Some improvements for commercial property are eligible for bonus depreciation, and some very, very specific improvements for residential property are qualified for bonus depreciation as well, but not your typical, remodel, renovation of a kitchen or anything. Those do not qualify. There's actually just very specific things that qualify, like certain landscaping is an example. Typical qualified assets are like I said, vehicles, manufacturing equipment, machinery, signage that you get for your business, like very expensive signage. Those kinds of things would likely qualify for bonus depreciation. And with vehicles, there's actually more rules to that than I just mentioned. If you get a regular vehicle, like a regular passenger vehicle, if it weighs over 6,000 pounds, then you can qualify for the full bonus depreciation of that vehicle, within the current year's limitations, whether it's 60%, 80%. If you get a passenger vehicle that weighs less than 6,000 pounds, then there are more limitations to how much you can take. But generally, commercial vehicles, they define it as like having multiple rows of seating and like commercial vans that are generally only used to store tools or supplies in the back. Those are usually eligible for the full amounts, up to the phased out limitation. Another thing that Tax Cuts and Jobs Act implemented was qualifying assets can be new or used as long as it's new to the business. So before this, it would only apply to new assets that you bought, that you purchased brand new. But now you can take it on used assets as well, as long as you take the depreciation, the bonus depreciation in the first year that you acquire the assets, and the asset has not been used by the business before, or has not been used by the owner of the business before, either selling it to the business or contributing it to the business. And this is just to eliminate, related party loopholes for taking the deduction. That's a broad sense of what bonus depreciation is and how it's changed over the years, and something to keep in mind that, the phase out limitation is kind of a major change that's affecting a lot of people, especially if you're used to getting 100% depreciation now to only 60% in 2024. So something to keep in mind there, and which is also important for me to bring up the Section 179 depreciation rules and how that compares to bonus depreciation. So Section 179 is a slightly different method of, incentivized and accelerated depreciation. And one of the main differences is that when you're talking about bonus depreciation, if you take a bonus depreciation and it brings your business's net income below zero, resulting in net loss, you can still take that depreciation and take the net loss. If you use a Section 179 deduction, it can only bring your business income down to zero. If there's more depreciation expense after that, then it has to be carried forward to the next year until you can use it up. So that means that the Section 179 deduction cannot generate a net loss for your business. There are lower limits also to the Section 179 depreciation. So when I mentioned before about the revenue limitations and asset purchase limitations for the bonus depreciation, you have lower limits for Section 179. However, with 179, you have more flexibility on how much of the accelerated depreciation you want to take in that first year. You have flexibility to choose, hey, instead of taking the full amount, maybe I just want to take 60% for whatever reason. You might be doing some tax planning, you think that might make the most sense. Whereas bonus depreciation, you have to just take the full amount as long as it's qualifying assets. The two similar things about the two depreciations is obviously you can use them both for new and used equipment, and also they're both accelerated forms of depreciation as long as you take it in the first year of your purchase and use of the assets. One important thing to keep in mind is you can actually use both methods of depreciation on the same assets in the same year, as long as it's in the same year. So let's say there is a limitation on bonus depreciation of 60% in 2024. You can look into possibly using Section 179 on the remaining basis of the asset that you weren't able to bonus depreciate. So something to talk to your tax professional about, that could be done. All right. So I think that's a good overview of bonus depreciation, a little touching of 179. And if you found this video helpful, please do hit the like button. And really it helps to hit the subscribe button too, because it gets this informational stuff out to people who might need it most. And share it with people who might find it useful. Appreciate you watching, appreciate your time. And I'll see you next time, hopefully by the end of the week, for another video. Take care for now, and I'll see you then.
Like that, guess I gotta hit 'em with the update. Okay. I been getting to it when I'm up late. Hit it when you went the front gate. They act like that, hold up. Guess I gotta hit 'em with the update. Really with it, I ain't got a pump fake. Killer flow and hit 'em with the one take. Act like that, Guess I gotta hit 'em with the update. Okay. I been getting to it.